Hi, this is Joseph. It's Sunday, June 16th. I'm going to talk about Friday's SPY action, show you how tendency was working, and I also want to show you how to get how to slay this last move right here and what's going on here in general. So, in general, time zone tendency on a something other than a big order flow agenda day, on something that occurs 70-80% of the time, which is trend and tendency, where patterns and waves and tendencies are tending to play out. This was a pretty good day, as you can see here. You're looking for it to wedge up at neutral, which is the neutral is between the gray crosses, which is VWAP, and the gold dots, which is 50% of the developing range. At when 10:30, there it is, perfect, and again at 1:15, perfect. I had those ellipses in TradingView put on early, and we were looking for the urging to the price urging to those zones, and it definitely got there, and it was great. And 10:30 guys put on a move, covered when they should, etc. And if you were using this, you would have stayed. You would have been, especially you would have been in front of it, because at those junctures, these took off. And this is tick Q, at highs dot New York minus at low New York, and the same thing for the NAS. But anyway, I don't want to dwell on all the intraday tendency. It was nice, There's a big gravity between 50% range and VWAP always, and you can see how many times it returned to that zone. And there's the second big gravity, which is the big stasis gravity, is the opening 1 minute range, which is this yellow zone here. So price, tends to move around both of those. And it takes a real force or a catalyst to get away from that and to go into a trend. So you can see where we opened, right in the opening 1 minute range, came back, touched it there, and there. But what I really want to get down into is how to use some of the dynamic tools that are in like TradingView and other venues to see what's happening and get in front of it. So I'm going to concentrate on this last section here. And I'm always looking for waves. It's my contention that waves and wave force are everywhere, and once you see them, you can't not see them, and they generally revolve around Elliott rules, but in today's market, they get tweaked by momentum and people recognizing patterns earlier and pushing them and then stepping on them. So when I look at this, because I just have the eye trained for it at this point, I can see 5 waves in here, 5 wave force exhausting and turning back down. And I'll show you what I mean. This is the point of control for the day, this purple line. So when you get into something like this, and there was a little wedge there, and the 115 wedge, it's usually not as dynamic as the 1030 because there's not many people playing. It doesn't often take off out of that neutral zone as quick. So what you have to do is keep extending the pennant. It's really a pennant, behaves like a pennant, and then you can box in the highs, lows, because what they're doing in there is probing until they see which side is stronger. Then they'll push into the weakness with strength. In this instance, they determined that was going to be up, and frankly, there was more people covering toward the end of the day. But so you keep extending the box and the wedge until that breaks, and there it goes. So that's from right there on, that's a new impulse. There's going to be emotive waves and corrective waves in there, and let's just look at it. So you see it going, and it comes up to the middle of the opening 1 minute range where it spends a lot of time, where you might imagine, because that's big gravity. But how do you look into that? And a lot of people do. People aren't just sitting around looking at 15-minute charts or whatever, or dailies. They're starting to break this down. They see that break, so they'll run that volume profile, and they'll keep running it in here until you get, all the way to there. But let's say at this point, you've got it run to there. So you're seeing this consolidation, you're seeing this come up. You start to see that 1, 2, 3, 4 movements in there. So you're looking for to me, this is like a 1, 2, 3, 4, 5. And if you keep breaking this down, and as you go along, you'll see you're looking for the point of control to move to price. Whenever it moves to price, it's the heaviest zone or level of trading, and there's the biggest churn. Usually means a shoulder, so that usually means a wave 2, wave 4. So this is 1, 2, and as you go up, when you're looking back at it, it's a little strange because it's different. So here's volume profile. You hit fixed range, and you drag you drag these little levels. So as you're doing that, as you're going along, you see two level changes here, another one here, another one to price here, and whenever that happens, it's old orders coming off, new orders coming on. So let me show you. If I just do the whole thing, you're going to see something interesting. So you're doing that as you're going along. You're looking for changes. You're looking for, I'm going to do the whole section now. So you can see right away from here, you see this one level, and then this other second big level up here. It's usually corresponding to a wave 2 and a wave 4. There's a little mini one there, and but when these come up and they both key off like that, and they cap something, when the point of control moves to price, you start looking to see which side is defending. So in my eye, I started looking for 5 subtle waves up. 1, 2, 3, 4, 5, and it's really subtle. But when you see that, then you start looking for exhaustion, and you're also thinking, okay, these people covered. There was a lot of people that wanted to cover by 230 and 330, and you're looking at the wave structure, and you're looking for the wave structure from the break. So 533, 1530, 330 is right here. So some people like to cover. So shorts are covering or exiting by 230 and then by 330, and then it goes to crazy time after that. But so you're looking for that covering pressure to ease off at 330. Same selling pressure will be there, but there was more covering pressure. So if you reduce the covering pressure, the buying, and you're at the end of what could be a 5-wave pattern, and you're a pretty far distance away from the opening 1 minute range, and then let's look, you're at the high of day, then you start to look over here, and let's say, where did these peak out? 120, 120, or 320, 320, 320, 320. So let's just say basically those broke at 20 after, and we're still going up here. Here's 30. So those are already diverging, and they're diverging in a pretty strong fashion. If you're tracking these lows with a trend line, I mean, you can also put trend lines in here. Also look in here, you can see waves in here. That's why I like them. Look at this, 1, 2, 3, 4, 5. So when I see a couple of those, I know that it's confirming the wave pattern in here. And if you're looking for like the 330 exiting to slow down and stop, and you see this breaking in here at 20 and turning, that's a heads up. Those are diverging. I got a 20, 20, 20, 20. So these get ahead of it. And what these are really is these are tick. You can look up. It's pretty easy to understand. It's similar to advanced decline, where things start moving up or down, and it correlates to that. But this is a little more interesting, because once you understand that when the market's going up, the highs are buying. People are buying the highs of a lot of different instruments, and usually high beta things like Amazon, etc. And they're not selling the lows. So when you subtract the highs from the lows, and it's a positive number, you're going up. The highs are being bought, and it's like if you could put a Bollinger Band over the market, and the top of the Bollinger Band were the highs that were new highs that were ticking off, and the bottom one was the new lows that were selling, you'd see the Bollinger Band going up, and it leads price, because they stop selling the lows and they start buying the highs when it's going up. And that's what this shows you. It gives you an added dimension to this. So this is, let's if it was moving averages, this would be like your daily moving average, and this would be like your 15-minute. You'd like this one to be going up and this one to come down and turn up, while that one's going up, to give you a signal, right? That's sort of the relationship between these. these at high, at lows are slower, but they're really important. And the ticks are much faster. The tick might go up while these are down, but if it goes up a couple of waves, then this kind of turns to turn around, and if it keeps going, then this starts to come up. So if these are above zero, and this is above and going up, things are going up, and this is leading price. So when you get up to here, you see that the many times that the point of control's moved up, that usually means shoulders, and you can get within these waves. You see the daily one didn't do anything. It's still telling you that this is a big anchor point down here, because this is where, in terms of the day, this is where most of the trades are occurring. But if you want to get into these legs. Anytime you see a leg going away from that, you want to run that point of control in there to see when the point of control moves up to price, because when it does, that is a big heads up that they're slowing down. That's the big churn level. Without it, you can't really tell that. So if you see the point of control move to that, you know it's the end of the wave. You know it's 330. 330 is coming off. Those covering pressures coming off, and you look to at high, at low, and tick, and they're descending well in advance. Well, that's all the divergence you need to sell, and you can catch something like this back down to where opening 1 minute range, or the space between VWAP and 50% range, etc. I don't know if that's a clear explanation, but there is a sequence in there that if you can understand and follow, you can get in front of stuff.